When we begin to understand the global economic consequences of this conflict, we have to start with energy, not because it is the only factor, but because it is the first domino. And that domino sits in a very specific place, the Strait of Hormuz. This narrow passage through which a significant portion of the world's oil flows represents something far greater than geography. It represents dependence, a shared reliance on a system that under normal conditions functions with remarkable precision and under stress reveals just how fragile it can be. Now, when tensions escalate involving Iran, particularly in a conflict environment that draws in actors like the United States and Israel, the stability of that system is immediately called into question. And markets react, not slowly, not cautiously, but instantly, because energy markets operate on expectation as much as reality. The moment risk enters the system, whether through potential disruption, military escalation, or even the threat of instability, prices begin to move. And those movements are not just numbers on a screen, they are signals that something fundamental has shifted. Now, what makes energy markets particularly sensitive is the lack of slack in the system. There is no vast reserve of idle capacity waiting to absorb shocks. Supply and demand are tightly balanced. So when even a small portion of that supply is perceived to be at risk, the impact is amplified. And that amplification is what we call volatility. But volatility is not just about price swings. It's about uncertainty. Because when prices move unpredictably, it becomes harder for businesses to plan, for governments to manage policy, and for markets to maintain confidence. And confidence in economic systems is everything. Now let's consider the psychological dimension of this, because volatility does not emerge in a vacuum. It is driven by human behavior. Traders respond to risk, investors respond to uncertainty, governments respond to pressure, and all of these responses interact in real time, creating a feedback loop. A rise in prices signals risk, that signal prompts further buying, that buying pushes prices even higher. And suddenly what began as a reaction becomes a cycle. Now, from a strategic perspective, this creates a very interesting dynamic because the economic impact of conflict is no longer limited to physical destruction. It extends into perception, into expectation, into the way markets interpret events and adjust behavior accordingly. And that means that influence can be exercised not just through force, but through disruption, through the ability to introduce uncertainty into a system that depends on stability. Now, consider how this plays out globally. As oil prices rise, energy importing countries feel immediate pressure. Their costs increase. Their currencies may weaken. Their economic outlook becomes more uncertain. At the same time, energy exporting countries may benefit in the short term from higher prices, but they also face increased geopolitical risk. So the impact is not uniform. It is uneven, and that unevenness creates tension because different parts of the global system are reacting in different ways at different speeds with different priorities. Now, let's zoom out even further because what we are witnessing is not just a market reaction, it is a systemic response. A response to the realization that a critical part of the global economy is under threat. And when systems recognize threat, they begin to adapt. But adaptation takes time. And in the short term, the dominant response is volatility. Now, there is also a deeper philosophical question embedded in all of this. Why is the system so sensitive? Why does a disruption in one region have such an immediate and widespread impact? And the answer lies in interdependence. The global economy has been built on the assumption that resources will flow freely, efficiently, and predictably across borders. That assumption has enabled growth, innovation, and integration, but it has also created vulnerability. Because when systems are tightly connected, shocks travel quickly, and the more efficient a system becomes, the less room it has to absorb disruption. So what we are seeing is a paradox. The very efficiency that drives global prosperity also amplifies global risk. And energy markets are one of the clearest examples of that paradox in action. Now, from a policy perspective, this creates a series of difficult questions. How do you stabilize markets without overreacting? How do you manage inflation without stifling growth? How do you respond to volatility without reinforcing it? These are not easy questions, and they do not have simple answers because every intervention has consequences, and those consequences can ripple through the system in unexpected ways. Now, let's bring this back to the core idea. Energy shock is not just an economic event. It is a signal that the system is under stress, a signal that the assumptions we rely on about stability, predictability, and flow are being challenged. And once those assumptions are challenged, behavior begins to change. Markets become more cautious, investors become more selective, governments become more defensive, and over time, those changes can reshape the structure of the global economy. But in the immediate term, what we see is volatility, sharp movements. Rapid adjustments, a system trying to find a new equilibrium under pressure. And that process is not smooth. It is uneven, unpredictable, and at times destabilizing. So when we talk about the economic consequences of this conflict, we have to understand that energy is the starting point. It is the first signal, the first disruption, the first indication that something deeper is happening. Because once energy markets move, everything else begins to follow. And the question we are left with is not just how high prices will go or how long volatility will last. It's whether the system can absorb the shock without fundamentally changing. Because in a world built on interconnected systems, the true impact of a disruption is not just how it begins, but how far it spreads, and whether in the process it forces us to rethink the very foundations on which that system was built. Once energy prices begin to rise, the impact doesn't remain confined to markets or balance sheets. It moves into something much more personal. It enters daily life. Because inflation, especially when driven by energy, is not just an economic concept, it's an experience. And that experience is felt unevenly, often most sharply by those who have the least room to absorb it. Now, think about how this works in practice. When oil prices rise due to instability involving Iran and disruptions around the Strait of Hormuz, the first visible effect is higher fuel costs. Transportation becomes more expensive. Logistics chains begin to adjust, and those adjustments cascade through the system. But what's important to understand is that energy is not just one input among many. It is a multiplier. It touches almost every sector of the economy. So when energy costs rise, they amplify costs everywhere else. Now consider food. Agriculture depends heavily on energy, fuel for machinery, energy for irrigation, and oil-based inputs like fertilizers. So when energy prices increase, food production becomes more expensive. That cost is then passed along through processing, transportation, and retail, and eventually it reaches the consumer. But by the time it does, it is no longer a single increase. It is layered, incremental increases at each stage, compounding into something much larger. Now, the same pattern applies across industries. Manufacturing costs rise. Construction becomes more expensive. Services from shipping to travel adjust their pricing. And what emerges is a broad-based increase in the cost of living. This is the hidden tax of inflation. Because unlike a direct tax, it is not announced, it is not debated. It is not even always immediately visible, but it is felt. Every time someone fills their car, buys groceries, pays for basic services. Now, from a policy perspective, this creates a very difficult environment because central banks are tasked with maintaining price stability, but the tools they have, primarily interest rates, are blunt. If inflation rises, they can increase interest rates to slow demand. But slowing demand also slows the economy. It can reduce investment, increase borrowing costs, and in some cases lead to higher unemployment. So policymakers are constantly balancing competing priorities: stability versus growth, control versus momentum. And in a situation driven by external shocks like geopolitical conflict, those trade-offs become even more complex. Now, there is also a political dimension to this, because inflation is not just an economic issue, it is a social one. When the cost of living rises faster than wages, people feel it immediately, and that creates pressure. Pressure on governments to respond, pressure on institutions to act. And sometimes pressure that manifests in ways that are less predictable through public dissatisfaction, political instability, or shifts in leadership. Now let's step back and consider the global dimension, because inflation does not affect all countries equally. For wealthier economies, higher prices may be absorbed more gradually. There are buffers, savings, institutional capacity. But for developing economies, the impact can be far more severe. Higher energy costs can strain national budgets, increase import bills, and weaken currencies. And when currencies weaken, the cost of imported goods rises even further. So what begins as an external shock becomes an internal crisis. Now, this is where the concept of inequality becomes important, because inflation tends to hit lower income populations harder. They spend a larger portion of their income on essentials, food, fuel, housing. So when prices rise, they have fewer options, fewer alternatives, less flexibility. And that amplifies the social impact of economic disruption. Now, from a philosophical perspective, this raises an important question. What does it mean for a global system to be stable? Is stability defined by growth, by efficiency, or by resilience, the ability to absorb shocks without disproportionately affecting the most vulnerable? Because what we are seeing in this moment is a test of that resilience, a test of whether the system can handle disruption without deepening inequality, without creating lasting economic scars. Now, there is also a psychological layer to inflation that is often overlooked, because inflation changes how people think. When prices are stable, expectations are stable. People plan, they invest, they make long-term decisions with a sense of predictability. But when prices become volatile, that predictability erodes. People become more cautious, more defensive. They delay spending, they reduce risk, and that shift in behavior can in itself slow economic activity. So inflation is not just about higher prices, it is about changing behavior. And when behavior changes across millions of individuals and businesses, the entire system adjusts. Now let's connect this back to the broader conflict. What we are seeing is not just a regional issue. It is a global transmission mechanism, a chain reaction that begins with energy disruption and extends into the core of everyday economic life. And that chain reaction reveals something fundamental about the modern world. It reveals how interconnected we are, how dependent we are on stable systems, and how quickly those systems can come under pressure. Now, the key insight here is this. Inflation is not just a consequence. It is a signal that the system is absorbing stress, a signal that costs are being redistributed, and a signal that the balance between stability and disruption is shifting. And once that shift begins, it is difficult to reverse quickly. Because inflation, once embedded, tends to persist. It becomes part of expectations, part of decision-making, part of the system itself. So the challenge is not just to respond, but to respond in a way that restores confidence, that stabilizes expectations, and that protects the most vulnerable, because in the end, the true cost of inflation is not measured in percentages. It is measured in impact, in how it shapes lives, in how it influences decisions, and in how it tests the resilience of the systems we depend on. And that leads us to a final reflection. In a world where economic shocks can travel across borders in an instant, the real question is not just how we manage prices, but how we manage fairness. Because stability is not just about keeping markets calm. It is about ensuring that when disruption comes, as it inevitably will, the burden does not fall most heavily on those least able to carry it. So as the conflict continues to unfold, the disruption doesn't stop at energy or inflation. It moves into something even more structural, something that underpins the modern global economy itself, supply chains. Because for decades, globalization has been built on a simple assumption that goods can move efficiently, predictably, and at relatively low cost across borders. That assumption has shaped how companies produce, how countries trade, and how economies grow. But in a moment like this, that assumption begins to fracture, and it often begins in places that sit at the intersection of geography and commerce, places like the Strait of Hormuz. Now, when instability rises in such a critical region, the immediate concern is energy. But very quickly, the impact spreads to shipping more broadly. Because shipping is not just about oil. It's about everything. Raw materials, manufactured goods, food supplies, all of it moves through a network of routes that depend on stability and security. And when even one part of that network becomes uncertain, the entire system begins to adjust. Now, consider what that adjustment looks like. Shipping companies begin to factor in higher risk. Insurance costs rise. Routes may be altered to avoid potential conflict zones. Deliveries slow down. Costs increase. Individually, each of these changes may seem manageable, but collectively they create friction. And friction in a system designed for speed and efficiency is disruptive. Now, here's the key idea. Global supply chains are optimized for efficiency, not resilience. Over the past few decades, companies have built systems that minimize costs, just-in-time production, lean inventories, tightly coordinated logistics. These systems work exceptionally well under stable conditions, but they have very little margin for disruption. So when instability enters the system, whether through conflict involving Iran or broader regional tensions, it exposes that lack of resilience. Delays in one part of the chain ripple outward. A shipment that arrives late affects production schedules. Production delays affect distribution. Distribution delays affect availability. And suddenly a localized disruption becomes a systemic issue. Now, from a business perspective, this creates uncertainty, and uncertainty forces change. Companies begin to rethink their strategies. Do they continue to rely on long, complex global supply chains, or do they bring production closer to home? Do they prioritize cost efficiency, or do they invest in redundancy and flexibility? These are not simple decisions, because resilience comes at a cost. Diversifying suppliers, holding larger inventories, building alternative routes, all of these measures increase expenses. But the alternative, remaining vulnerable to disruption, carries its own risks. So what we are seeing is a shift in thinking, a gradual movement away from pure globalization towards something more fragmented, more regional, more cautious. Now, this doesn't mean globalization is ending, but it does mean it is evolving, becoming less about maximum efficiency and more about managing risk. And that evolution has consequences because global trade has been a major driver of economic growth. It has allowed countries to specialize to access new markets to lower costs. So when trade becomes more complex, more expensive, more uncertain, it affects growth, it affects investment, it affects opportunity. Now, there is also a geopolitical dimension to this shift because supply chains are not just economic structures, they are strategic ones. They determine who depends on whom, who has leverage, who has alternatives. And when disruptions occur, those dynamics can change. Countries may seek to reduce dependence on regions perceived as unstable. They may strengthen ties with more reliable partners. They may invest in domestic capacity. And over time, those decisions can reshape the global economic landscape. Now, from a psychological perspective, this creates a sense of fragility because the assumption of seamless global connectivity begins to weaken. Businesses become more cautious. Governments become more protective. And that caution can in itself slow the pace of globalization. Now, let's take a step back and look at the bigger picture. What we are witnessing is not just disruption, it is revelation. The conflict is revealing the underlying structure of the global economy, its strengths, its efficiencies, but also its vulnerabilities. And once those vulnerabilities are exposed, they cannot be ignored. Now, there is a deeper philosophical question here. What is the purpose of a global system? Is it to maximize efficiency at all costs? Or is it to provide stability and resilience in the face of uncertainty? Because those two goals are not always aligned. Efficiency often requires concentration, fewer suppliers, fewer routes, tighter systems. Resilience requires diversification, more options, more redundancy, more flexibility. And finding the balance between those two is one of the defining challenges of our time. Now, in the context of this conflict, the balance is shifting, slowly but noticeably, toward resilience, toward caution, toward a recognition that the world is more uncertain than it once appeared, and that recognition is changing behavior. Now, the most important insight here is this. Supply chains are not just about goods. They are about trust, trust that systems will function, trust that agreements will hold, trust that disruptions will be limited and temporary. And when that trust begins to erode, the system changes. It becomes more guarded, more fragmented, more complex. And that has long-term consequences because rebuilding trust is much harder than maintaining it. So as we look at the economic consequences of this conflict, we have to understand that supply chain disruption is not just a temporary issue. It is part of a broader transformation, a shift in how the world organizes production, trade, and interdependence. And that shift will continue long after the immediate crisis has passed, because once a system has been tested and found vulnerable, it does not return to its previous state unchanged. And that leaves us with a final thought. In a world where the movement of goods defines prosperity, the real question is not just how we keep those goods moving, but how we build systems that can continue to function when movement is no longer guaranteed. By the time we reach this stage of the conflict, the effects are no longer just visible in oil prices or supply chains. They begin to show up in something more abstract, but no less powerful: financial markets. Because markets are not just mechanisms for buying and selling. They are systems of belief. They reflect how investors see the future. And when that vision becomes uncertain, everything begins to shift. Now, think about what uncertainty really means in this context. It's not just about what is happening today. It's about what might happen tomorrow. Could the conflict involving Iran escalate further? Could it draw in more actors? Could it disrupt additional parts of the global economy? These are not questions with clear answers. And that lack of clarity is exactly what markets struggle with, because markets prefer predictability. They function best when risks are known, when outcomes can be modeled, when probabilities can be assigned. But in a geopolitical crisis, the range of possible outcomes expands dramatically. And that expansion creates volatility. Now, volatility in financial markets is often misunderstood. It's not just about prices going up or down. It's about confidence moving. Because when confidence is high, investors are willing to take risks. They invest in growth. They support innovation. They allocate capital toward long-term opportunities. But when confidence declines, behavior changes. Investors become more cautious. They move capital into safer assets. They delay decisions. They wait. And that shift from risk-taking to risk avoidance has real consequences. And because investment is the engine of economic growth. So when investment slows, growth slows. Now let's consider how this plays out globally. Stock markets may react sharply to escalating tensions. Currencies may fluctuate as investors reassess risk. Capital flows may shift from emerging markets to more stable economies. And each of these movements reflects a deeper process, the reallocation of trust. Now, this is where the concept of safe havens becomes important. In times of uncertainty, investors look for places where their capital is less exposed to risk. That might be certain currencies, certain bonds, or certain markets perceived as stable. But when large amounts of capital move quickly, it can create imbalances. Some economies receive inflows, others experience outflows, and those shifts can amplify existing vulnerabilities. Now, from a systemic perspective, this creates a kind of fragmentation because instead of capital flowing efficiently to where it is most productive, it flows defensively to where it feels safest. And that changes the structure of the global financial system. Now, there is also a longer term dimension to this because repeated exposure to geopolitical risk changes how investors think. It alters their perception of what is stable and what is not. Regions that were once seen as reliable may be reassessed. New risks may be priced in. And over time, that can influence where capital is allocated on a more permanent basis. Now, let's connect this to the broader economic picture. As financial markets become more cautious, access to capital can become more constrained. Businesses may find it harder to secure funding. Governments may face higher borrowing costs. And innovation, especially in riskier sectors, may slow. So the impact of financial uncertainty is not just immediate, it shapes the trajectory of growth. Now, from a psychological perspective, this is about perception. Because markets are forward-looking. They are constantly trying to anticipate the future. And when the future becomes harder to read, behavior becomes more conservative, more defensive. And that collective shift in mindset can become self-reinforcing. Less investment leads to slower growth. Slower growth reinforces caution. And the cycle continues. Now, there is also a deeper philosophical insight here. Because financial markets at their core are built on trust. Trust in institutions. Trust in stability. Trust in the rules of the system. And when that trust is challenged, whether by conflict, uncertainty, or disruption, the system begins to adjust. Not collapse, but recalibrate. Now, this recalibration is not necessarily negative. In some cases, it leads to more prudent decision-making, more careful risk assessment, a greater focus on resilience, but it also comes with trade-offs, because a system that is more cautious is also less dynamic, less willing to take risks, less capable of rapid growth. So again, we return to the balance between stability and dynamism. Now, in the context of this conflict, what we are seeing is a shift along that spectrum, away from optimism, toward caution, away from expansion, toward preservation. And that shift is being reflected in financial markets around the world. Now, let's step back and consider what this means at a deeper level. Because financial markets are not just reacting to events. They are interpreting them. They are translating geopolitical risk into economic signals, and those signals influence decisions at every level, from individual investors to global institutions. And so when markets become volatile, it is not just a reflection of uncertainty. It is a transmission mechanism, a way in which the effects of conflict spread into the broader economic system. Now, the key insight here is this. Confidence is not a constant. It is a variable, and in times of crisis, it becomes one of the most important variables of all, because confidence shapes behavior. And behavior shapes outcomes. So when confidence is disrupted, the effects can be profound, not always immediate, but cumulative. Now, as we bring this into the broader narrative of the speech, we begin to see a pattern. Energy disruption leads to price volatility. Price volatility leads to inflation. Inflation leads to economic pressure. Supply chain disruption leads to structural change. And financial market uncertainty shapes the long-term trajectory. Each layer builds on the previous one. Each consequence amplifies the next. And together they form a system under stress. Now, the question we are left with is not just how markets will respond in the short term. It is how they will adapt over time. Will confidence return quickly? Or will caution become the new norm? Will capital flow freely again? Or will it remain constrained by risk? Because the answers to those questions will determine not just the outcome of this crisis, but the shape of the global economy that emerges from it. And perhaps the most important thing to remember is this. Markets do not just reflect the world as it is. They reflect the world as we believe it will be. And when belief is shaken, the consequences extend far beyond finance. They shape the future itself. So the final question is this. In a world where uncertainty is becoming more common, how do we rebuild confidence, not just in markets, but in the systems that those markets depend on?